We are going to begin, though, with some positive news on the economy. According to fresh data released this morning, inflation is down 0.1% from the month of June, putting the rate over the past year at 3%. That is slightly lower than economists predicted. So to break down what this all means is CBS News business analyst Jill Schlesinger. Okay, Jill, we're continuing to move in the right direction.
Yeah, that's great news, right? I know it's slow progress, but we like to hear good news when it comes to these price increases slowing down. Now, to be clear, I mean, we did have that month-over-month decline. It doesn't mean that prices overall are dropping. It means that the rate of the increase of prices is slowing down. Remember, we were back at 9% 2 years ago at the peak of this. Now we're at 3%. The Fed wants us to get towards 2%. That's their goal. So we're making progress. We're not there yet, but I think this is indeed good news.
So this is going to sound like a really basic question, but I think in all of our talk about inflation, we haven't actually talked about this. Can you talk a little bit more about the relationship between the rate of inflation and just prices?
Well, listen, I get this. It's so confusing because you hear someone like me say, oh, we're making progress, but then you go shopping and you say, what? What's she talking about? And the reason is that inflation is sort of a natural occurrence in the economy. We see in a good economy, let's say, we have a 2% inflation every year. This is kind of where we were for the 10 years leading up to the COVID crisis. Then the COVID crisis hit and we had a spike in the inflation rate, meaning that increase in prices was going crazy. Now, the problem is all those increases that took place during the COVID years, they're still with us. So prices overall are still 23% higher than they were 5 years ago. In a normal sort of operating economy, we would have seen, say, 11% increases. So what does this really mean to you and me when we go out into the economy? Prices are higher than we would have been had we never had this big spike in prices. But that said, we are seeing the rate itself, the rate of increase coming down. Again, that's the good news here.
So this report is coming as Federal Reserve Chair Jerome Powell delivered 2 days of testimony on Capitol Hill. I thought it was really interesting. I mean, lawmakers are clearly a bit frustrated and were outright asking him, when are you going to lower the interest rates? Like, when is it happening? And he said, look, I'm not going to tell you anything, basically. But I thought what was interesting is that he also said that, look, it's not just inflation that we're looking at. We're looking at other factors as well. Can you talk a little bit more about, besides inflation, what's the Fed looking at to determine whether or not it's time to bring these interest rates down?
So the Fed has two big jobs, okay? It's called the dual mandate. Flip that out at your barbecue this weekend. You'll sound very smart. And what it means is there are two issues that the Fed is concerned with. Price stability, meaning that bringing that inflation rate down, but also the Fed is responsible for fostering enough economic growth so that the job market is solid. Now, that's why Jerome Powell started talking a lot about the labor market in these testimonies, because what he's really trying to say is it's a delicate balance, right? If we leave interest rates too high for too long, we risk slowing the economy down and then seeing the job market start to falter. What does that really mean for us? It means if they keep rates high for too long, we might start seeing job losses and wage stagnation. So that's the delicate balance between these two issues. Bring the inflation rate down. Yes, we want that, but don't do that at the expense of cutting off the labor market at its knees.
Right. All right, Jill, thank you very much.
Sure.